Hello again everyone, I'm Corey Halliday and welcome out to this presentation. I want to go through a Forex trade, really a variety of different trades that we're going to put on here in USD. We're going to talk about a fundamental reason, a technical reason to get long US dollars here. So let's talk about first the fundamentals behind it. When you think about currencies, we think about US dollar as being a major currency. Now remember, the US dollar is a reservable currency, which means that international markets will use the dollar for financing the purchase of commodities, things like that. Also, these big central banks will use US dollars to stabilize their own currency. They can use that in reserves. Well, in the old days, all of these currencies had to be backed by, specifically the US dollar, had to be backed by gold. What was the gold standard? So you'd have this gold that was backing up the US dollar. And if you wanted to print more dollars, you had to have more gold. Well, a century or so ago, they changed that. And they changed that to fiat currencies. And when that changed, it basically became a faith-based currency. The currency has value because people believe that it has value, but it's no longer backed by a physical commodity. So the US dollar has transitioned in this manner, and really international currencies have done the same. The euro, the Swiss franc, they're all now fiat currencies. So what does that mean for the currency markets, and why do we want to buy US dollars here? Well, the US dollar is the strongest of all of the currencies right now. If you were to look at a long-term chart of the dollar, if we stretch back multiple years, the dollar had this big basing pattern for a few years there. I'd call it 2011 through 2014, basically. You spent all this time in this kind of sideways range. In late 2014, we broke out violently to the upside. And the US dollar has been on a tear since then. 2015 and late 2014 into 2015, the US dollar took off to the upside. While the dollar was breaking higher, we know that commodities will oftentimes have an inverse correlation, which means that the oil prices, for example, which were range bound here, up around $100 a barrel, as the US dollar broke out, guess what that meant for oil? Well, oil collapsed to the downside. Now it's priced in US dollars and it's down to about $40 a barrel for oil. This was unheard of. This was unthinkable. When oil was at 100, people thought, well, it's going to stay there forever. It's going to go higher. People didn't understand that actually oil prices can go down, gas prices can go down. We kind of became indoctrinated with this idea that oil always went up, and commodities generally, and it's just not true. Oil has collapsed, and a big part of that is US dollar strength. Well, fast forward to today, and we've been in kind of a basing, kind of a range to the downside. And this is what we would call a bull flag pattern on a long-term chart. So a bull flag pattern is basically when you're in a bull market, you'll still have corrective periods. And this corrective period brought the US dollar down. We think the next major move, though, is still higher in US dollar pairs. Now, when I say that the US dollar is the strongest, I'm talking about this long-term multi-year picture. In addition, we have the #1 economy in the world. Now, you might say, well, the US markets are not all that strong. In fact, the markets are expecting a GDP number on Friday, and the expectations are for GDP to come in at 1%. Now, that is not robust growth, but it's better than a lot of international markets. Emerging markets have been in recessionary periods and have had negative growth. And more importantly, markets are always forward-looking. There's a reason that GDP right now doesn't really have a major impact, but future GDP down the line, such as fourth quarter 2016, that's going to be more impactful. And there's a saying that the equity markets price in 6 months ahead of time. So GDP in the fourth quarter is more important. We're anticipating it to be 3% growth. In addition, inflation is going, and it's going to go up and reach 2%. We had 3 different Fed speakers this week all talk about a future rate hike, possibly as soon as April. I think that is on the table. I don't think they'll raise in April, but the US dollar is going to be the beneficiary of rate hikes. And rate hikes are not happening anywhere else. The Reserve Bank of New Zealand, for example, they just cut rates. There's talk now that the UK may cut rates, the Bank of England, and so forth. We're in a rate cutting kind of currency devaluation mode in international markets, but the US markets are actually stabilizing. We're going to see solid growth in our estimate. The Fed is going to raise rates, and that's a perfect backdrop for US dollar strength. If we look at this long-term chart, the dollar index, what people call the Dixie, it's struggled against 100 for quite some time. I think it goes up and it blows through that level. Euro USD, which is the major currency pair, is trading at about 112 right now. I think it goes as low as the figure, meaning that we have over 12% depreciation in the euro versus the US dollar in the coming years. I firmly believe that to be the case. The dollar is going to be a huge beneficiary. You want to buy the dips, especially against the commodity currencies like the Aussie, the CAD, the Canadian dollar in other words, the RBNZ cutting rates, that means the Kiwi. So I would short Aussie, Kiwi, so AUD, NZD, and CAD, the Canadian dollar. Those three major commodity currencies, you short those against the dollar for the months, probably the next couple of years. This is a long-term trade. We're in a position on a US dollar long trade, actually shorting the Kiwi as an example of what I'm talking about. We want to stick with those types of opportunities. The dollar has strengthened about 1.5% this week versus other currencies, and it's only going higher from here. Look for those opportunities and jump on. Hope you've enjoyed this and learned some things. We'll see you next time. Goodbye, everyone.